2-year should go way lower and the curve should steepen, Rick. What's it all going to mean?
Well, I think the curve could steepen real quickly. I want to dig in on something that Kyle just said that was also in the Journal. The Journal this morning said we import $400 billion from China. Kyle Bass said $440 billion. Think about that number. Now, I'm going to ask you a question, Kelly and Sully. What size budget deficit do we currently have, roughly? About $1 trillion?
About two.
Okay.
Yeah.
Think about $1 trillion plus on the deficit versus all the entire imports from China are less than half of that deficit. That really frames out the problems that we have. Now, let's get back to the market, shall we? If you look at 2-year and 10-year, you'll see a couple of things. Coming into our time zone, around 6 a.m., we saw yields start to drop. The flight to quality, nervousness over equities running around the clock. Then, around 11 o'clock Eastern, we saw rates tick back up again. That was obviously, as you've all been talking about, the Vietnam Trump phone call that he put on his social media. Now let's move on a little bit. I tweeted earlier that we haven't closed below 4% since October 4th of last year, and we are flirting with that level. We just touched it and bounced back off. It really is a big psychological level. But if you're looking at the crash, 15% on a 10-year was lost in 1 week in October 87. If you make that and put it into today's numbers, that would come up with a yield of 3.71%, just to throw it out there. And if we look at the liquid LQD, which is the investment grade ETF, and you look at the HYG, the high yield junk ETF, I find it so fascinating, the differentiation there. The LQD looks like nothing's going on. The HYG is going to close at the lowest price since July of last year. And then finally, the dollar index is just going wild today. It's up over 1%. It's got over half back of its 2% drop since last Friday, at least as evident by where it was on Wednesday and Thursday morning. Brian, back to you, and have a restful weekend.
Yeah, I'm sure restful is probably a CNBC special Sunday night. Rick Santelli, thank you. All right, after the break, how far will President Trump go with tariffs, and how much do Americans, especially younger Americans, really care about this? Derek Thompson of The Atlantic also just co-wrote a book. So it's a bestseller. It's called Abundance. You got to read it. And Derek is next.
CNBC. Live ambitiously. Live from the New York Stock Exchange. Halftime report. CNBC.
To me, ambition is drive. It's the fire in your belly. I didn't go to college right out of high school. I worked full-time while doing school full-time. Somewhere along the way, I got bitten by the journalism bug. No one's going to give you your dreams. You have to roll up your sleeves and work hard to achieve them. Money doesn't make the world go round. Information does. And CNBC is the great economic equalizer because we provide that information so you can make the decisions that are right for you. CNBC is an adventure beyond my wildest dreams.
So this is the best dish to me in Vietnam. Good childhood flavor.
Hi everyone, my name is Thủy Tiên and welcome to Ho Chi Minh City. Lotto is the name of the game, just like bingo in America.
Vietnamese people drink coffee every day. If you drink the Vietnamese coffee, you can recognize the difference in the Vietnamese Robusta beans. It's a very strong, very resilient beans. Bitter.
I think it's quite hard to the foreigners to imagine what they have in Cơm Tấm. You can find a lot of different kind of seafood here because we have a long coaster. It's like the time when you're visiting and socializing with your friends and family. 1, 2, 3, go! Join me during my downtime.
Want to make some extra money, but not sure where to start? CNBC Make It will teach you the skills to earn passive income online. Take our new online course that will help jumpstart your business idea. Get expert advice and hear real-life success stories.
Soon, you'll have the tools that you need to start your own passive income business.
Learn how to start generating additional income right now. Register at cnbcmakeit.com/passive income today.
Welcome back. The president's team tried to make it clear yesterday, tariffs are the future and there are no negotiations. But is that true?
I don't think there's any chance that President Trump's going to back off his tariffs. This is the reordering of global trade.
Let me make this very clear. This is not a negotiation. This is not that. This is a national emergency.
Are you open to deals with these countries if they're calling you?
Well, it depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good, the tariffs give us great power to negotiate.
All of that said, there may be some negotiating going on. The president posting on Truth Social, he had a good call with Vietnam's leaders that turned some of the exposed stocks like Nike, the other footwear makers, around. And moments ago, the EU Trade Commissioner tweeting he had frank talks with the Commerce Secretary and the U.S. Trade Rep, saying U.S. tariffs are damaging and unjustified, and the trade relationships between the U.S. and EU need a fresh approach. So what's the strategy here, and how does the public feel about it? Let's bring in Derek Thompson. He's a writer at The Atlantic and co-author of the new book, Abundance. All right, Derek, have at it. I mean, where do we start? Do we say, well, the stock market reaction is one thing, but we're trying to do something different for this country. We're trying to make housing affordable again. And I don't know. Where would you point our attention?
To be totally honest, Kelly, I've been listening the last 10 minutes of this show. I cannot believe what I'm listening to. I heard your last guest say, if the economy shrinks, that's good. If the stock market goes down, that's good. If the housing market crashes, that's good. If there's a trade war, that's good. When did the capital class get taken over by degrowther protectionists seeking 19th century autarky?
Okay, but Derek, let me just jump in for a second, because if there's one refrain we've heard from millennials over the past several years, it's that the dream is gone. They can't afford a house. Groceries are too expensive.
It's literally the first chapter of Abundance.
It's apparently the first chapter of your book. So aren't you a little surprised to hear the globalists, the pro-stock market types who are supposed to be at fault for all of this, now reading out of your book and saying we're bringing prices back down?
They're crashing the economy. That's very, very different than making housing affordable. If you want affordable housing, you need a job. If you crash the economy, you're going to have unemployment. And whenever unemployment hits an economy, as we just saw in 2008 and we saw before in the 1990s, who loses their jobs first? It's last one in, first one out. It's young people. So if your job or if your plan is to crash the economy in the short term for the purpose of helping young people afford a house, you have got it totally backward. Young people need jobs, they need money, and then they need a plan to make housing affordable. Right? Donald Trump could have come into office and said, what I want to do is to make the construction of housing affordable. That means the inputs to housing. Instead, he slaps a 25% tariff on Canada, which we import our lumber from, and a 25% tariff on Mexico that we get drywall gypsum from, thus immediately raising two of the most important inputs for housing by 25%. This is a strategy to make housing less affordable at the same time that you make it harder for young people to keep a job because the stock market's puking. This is not the way to go about abundance. This is scarcity meeting scarcity. This is Trump saying we don't have enough housing, so we need fewer immigrants, or we don't have enough manufacturing in the U.S., so we need less trade. Abundance is a positive sum way of looking at the economy. It says we can grow if we invest in housing. We can have a strategy that seeks to make more of what we need in the U.S. without trying to cut ourselves off from the entire global economy. I completely reject the idea that what Trump is pursuing is anything like abundance. It is an explicitly zero.
So what's the, Derek, okay, by the way, I'm listening to Abundance. I love you. We've talked for over a decade. I'm listening to Abundance. I'm not all the way through. It's a fantastic book. You guys are getting a lot of attention. And I think one of the reasons you're getting attention for the book is that you're basically saying, listen, we are sort of centrist Democrats, self-admitted, but what we've been doing is not working, right? I think we can agree on that the path we've been going on, that rich liberal towns, they say we need more housing, but not here. Don't do it here. Like, do it somewhere else, but let's not do it here. I mean, we want it, but don't do it here. We agree that what's happened is not working. So, listen, you're right. This could send us into deep recession, crash the economy, jobs lost. I have no idea what's going to happen, Derek. Nobody really does. But do you agree that we need to try something different? Would you agree at least with that?
Oh, absolutely. We need to try something different. We need to make it much easier to build homes in cities and states that currently are torn up by rules and permitting processes and environmental review. We have a terrible housing shortage in this country. We have a shortage in California and New York, and unfortunately, it is worst in places where liberals have the most power. Right? This is a core theme of our book, that if progressives really want progressive outcomes, they need to think about the processes by which they achieve them. So absolutely, I think we should reform zoning laws in big cities, big productive cities that right now are terribly housing constrained. But that's very, very different, I think, from a housing policy that begins with tariffs that make it harder to build homes. 25% of construction workers in this country are immigrants. An enormous amount of materials that we import comes from overseas. We need an all-of-government understanding that if we want houses to be affordable, young people need good-paying jobs, and houses need to be plentiful. What we don't want is a world where young people are cut off from the opportunity ladder because there's a recession in their early 20s, at the same time that we make housing inputs affordable.
You and I have a lot in common, except that you're skinny, you got great hairline, and you wrote a best-selling book. None of those three things are true with me. But I think you're a guy that wants to find solutions. You sort of tweeted out, sort of semi-tongue in, by the way, the Dow's down almost 2,000. It's down 1,950. You tweeted out that we kind of need to do like a divorce, like there's this show in the Netherlands where divorced people go into a boat and they get divorced like 72 hours and they save time and money, that everybody gets into a room and do kind of a phone-a-thon on tariffs and rates, like kind of Vietnam was thinking about doing, maybe India, as I suggested, might do. And I think you meant it sort of tongue-in-cheek, Jarek, but I'm going to give you credit because you were at least looking for a solution, okay? I did kind of the same thing, and the Twitter horde comes out and they attack and whatever. What would Derek Thompson do? What is the solution? If what we're doing isn't working and we need to fix some things, what's the answer then? If it's not what Trump is doing, what is the answer? I don't know.
Look, Trump's in power and I'm not. So any solution to this problem has to start with the president.
Congress might disagree with that. I think there's going to be legal challenges to the tariffs.
I would hope you're right. I would hope that Congress reasserts its very constitutional authority on tariffs. But right now, I don't know if that's going to happen. So if I have Trump's ear, what I say is, Mr. President, you have an enormous opportunity to announce a 72-hour phone-a-thon of freedom. We want to get you on the phone with every single state leader around the world to work out individual, bilateral, free trade agreements with all of them. I want a beautiful Rose Garden speech at the end of this. You did it. 72 hours, phone-a-thon of freedom. We are back, baby. We've got tariffs torn down across the world. American economy can roar again, and we can help young people get and keep jobs that will allow them to buy housing. Honestly, I really do think it's incredibly important right now to persuade Trump that it is in his own interest and in the national interest to use what is right now a trade war to become a trade victory. As soon as possible, we need to work out these deals around the world because a trade war in which you got walls going up for every single country is a place where you have falling demand for every single global economy. That's a global recession. At the same time, by the way, that we're going to pass a $5 trillion corporate tax cut, which is going to be inflationary. And when you add falling demand to inflationary tax cuts, what you get is stagflation. I don't want the 1970s. I want the glorious 2020s. Get Trump on the phone right now. Get him talking to these global leaders. Have him work out these deals so that he can celebrate the deals that he got for America. And let's leave this all behind us because what's happening right now is absolutely madness.
Very quickly, the S&P is down 5.3%. We're waiting on a Microsoft event, Derek, so we might have to jump in and cut you off very quickly, Kelly. Sorry. If we get an S&P that's down 7%, trading is halted. We're down 5.3. 7's still a ways away.
Not that far away.
But it's not that far away.
It's a Friday. People don't want that exposure going into the weekend. And they're it's what Bill Gross told us yesterday. It's what he's been talking about today. There's a sense, it's what you talked about with Kyle Bass, the sense that it's a positioning unwind, and we need to learn more.
It's fear.
It's fear. The VIX is at 40, and we had Kilberg last hour who talked about, maybe when you get to 40, you start thinking about kind of dipping your toe back in. But this is a market that started out in the morning okay, got really upset after China announced the retaliatory tariffs. That's what initially sent us lower. Started to come back a little in the afternoon. Then we heard from the Fed chair. And then Powell was cautious and said, I'm not necessarily in a position to start running to the rescue. People have been talking about emergency rate cuts over the past couple of days. The chair clearly just about ruled that out. And that's when we've seen stocks taking a leg lower and yields coming up a little bit as well. So there you have it.
And look at that. It's on your screen. The Dow is down 2,000 points. That's just under 5%. I know the numbers get bigger as the numbers get bigger. So 2,000, the Dow was at 2,000 30 years ago. But we have gone up now over 40,000, not anymore. The Dow is down 2,000 points, Kelly, on a points basis.
Yeah.
We have lost almost 4,000 points in 3 days' time. The Dow didn't hit 4,000 until I think it was the early 1990s, or at least late 1980s. So we are down 5% right now on the Dow. NASDAQ, Russell 2000, small caps, all in bear territory, down 20% or more from their high.
A couple ways to put this in perspective also. It is extraordinary, the declines we've seen the last 2 days in a row. And it's been uncommon to see declines like this in the past 50 years or so. In fact, the NASDAQ has only had back-to-back 5% declines 3 times ever in 87, 01, and 08. So we'll see what happens today. The S&P 500, these could be the worst back-to-back declines. One of the worst 2-day declines we've seen in the past 50 years, other than in the pandemic in 2008. So this is a big repricing. And, just to put I know the numbers are big. We're down 2,000. It's not just in points. It's also, these are in percentage terms, one of the biggest 2-day sell-offs we've really seen in recent decades.
And basically wiped out a year of gains. The S&P 500, let's not forget, is still doubled from 4 years ago, but we just took out an entire year of gain. The NASDAQ, we've taken out more than a year of gain. I don't know if Derek is still there, but Stephen Stanley, chief U.S. economist at Santander U.S. Capital Markets, joining us. And everybody, I just want to apologize if we have to bail out because we're waiting on this important Microsoft event. Stephen, you just heard our conversation with Derek Thompson and Kyle Bass and others. Do you believe that what's happening in the stock market, which is ugly and terrible and awful, will translate to the American economy? And is the market predicting a recession?
Well, the market is certainly very concerned about a recession. I think in terms of whether it will translate, it really depends on how long it lasts. I mean, we've had plenty of episodes where the markets have moved drastically over a couple of days and then, whatever something happens and it goes back the other way. I don't think 1 or 2 days is necessarily going to make or break the economy, but certainly if financial conditions tighten and they stay tighter, that will be a problem.
Stephen, just kind of bring some of your experience here into the fold. So we're talking about sharp 2-day sell-offs. We're talking about analogies to 2008 and 2020 in terms of these declines. Obviously, there's a lot of differences between now and then as well. So what are the similarities? What are the differences? What strikes you as most important for the economy now?
Yeah, I think the biggest difference is that this, if I can put it this way, this calamity is entirely man-made, right? I mean, at any point in time, in theory, President Trump could come out and declare victory, as Derek suggested, and shift tack. And the economy seemed to be in pretty solid shape before Wednesday, so we could easily get back to something like that. I don't think that sort of a quick reversal was ever viewed as in the cards in either 2008 or 2020. So I think that's a big difference. And to me, at least at the margin, that does kind of hamstring the Fed a little bit, right? Because monetary policy works with a pretty long lag, and the Fed doesn't want to panic and react precipitously to something that might not be around in a month or 6 months or ever how long it's going to take for their policy moves to really take full effect.
I think that's exactly right, especially when you get a jobs report as strong as the one that it's ironic. It's probably the worst piece of news that the market could have gotten. If we added 40,000 jobs last month that were negative, I think the chair's speech would have had a very different tone.
Yeah, perhaps. I mean, I think there's no doubt that Chairman Powell and the Fed are stuck in a really difficult position. As with any negative supply shock, the tariff situation means that not only will growth be weaker, but inflation will be higher. And of course, the Fed can't address both of those problems at the same time. So they have to decide. And I think you've heard from Powell and others that they're a little bit torn between whether the bigger issue for them is going to be slower growth or higher inflation. If the severity of the market moves is any indication of what might be in store for the economy, then I think ultimately they're going to have to move in that direction, but I don't think they're in any rush to do so.
Yeah, and Derek Thompson is still with us, the Atlantic co-author of the best-selling book, Abundance. And so, Derek, your book is literally about growing the pie, sort of growing and you've taken, by the way, you and Ezra Klein have taken a lot of heat from the left. They're like, well, this is not traditional progressive ideals. Donald Trump, I traveled the country before before the election, I met with people who said, I've been a Democrat my whole life, but I'm a Labor Democrat and I'm voting for Trump because he supports jobs. Is it clear to you who anybody is these days? When you've got people coming on the show that are ostensibly Republicans who are like, we don't give a crap if the stock market crashes, if it's going to bring down interest rates. I don't know which side is up right now.
What bothers me most, honestly, is not that I don't know which side is which. It's that I don't think the folks who are in charge know what they're doing or why. If you look at the justifications for this policy, they're all over the place. You've got Peter Navarro saying tariffs are going to raise $600 billion a year. That suggests they're going to remain in place. You've got the tech folks who are associated with the Trump White House saying that actually this is just an opening negotiation tactic to force other countries to bring down their tariffs, and then we'll bring down ours. Well, wait, pause. You cannot raise taxes with a tariff that's designed to go away. So already you have parts 1 and 2 not making any sense. Then you have this third strategy, that's sort of Stephen Mirren's idea, that what we need to do is de-dollarization. Well, you just showed about 30 seconds ago that the dollar is actually appreciating right now because the entire global economy is puking. I don't think the folks in charge know what they're doing or why. And the reason that scares me on top of all of the obvious is that there's this theory that Donald Trump is this mastermind of uncertainty. And there's some reason to this, that if you have someone who is so great about uncertainty, they can get other countries to do what we want them to do. But the problem is that uncertainty is a double-edged sword. Domestic businesses need certainty to know how to invest. Domestic manufacturers need certainty to understand how to expand. If there's uncertainty in terms of our trade and tax and spending policy, how is a manufacturing company supposed to figure out how it's supposed to finance a doubling of their factory base? Yeah. They cannot do it. What we need now is absolute clear certainty. And as the previous guest said, going into January, you had a growing economy with declining inflation and rising employment, and there was no situation that required us to essentially yank out the oxygen as we're trying to climb Mount Everest. We can always just plug the oxygen back in. We could do it. Trump could have his phone-a-thon or something, but it doesn't seem to be happening right now.
This was supposed to be the most pro-business administration that we have seen. It's early. But right now, you wonder what CEOs are thinking as they watch their stock price go down 10, 20, 30, 40, 50% in a matter of days. Derek Thompson, the book Abundance, and The Atlantic, Stephen Stanley, Santander, gentlemen both, we appreciate it. We are miking up the CEO of Microsoft. Easy for me to say. The Dow is down 2,064 points.
So let's just give a little bit of a sense of the context here. We can show big tech since we're about to hear from Microsoft, and this may touch on AI plans. Obviously, shares of NVIDIA down 30% from the highs, and one of the big questions will be if we hear something now that gives us some clarity on the business path going forward. Andrew Ross Sorkin is live at Microsoft's headquarters in Redmond, Washington for a CNBC exclusive. Andrew?
Thank you. And it's a big one because we don't just have one CEO. We actually have all three CEOs of Microsoft over the last, 50 years now. They are celebrating their 50th anniversary. It's a big one. Let me tell you who's here. The three CEOs of Microsoft throughout its history. Bill Gates is here, the founder of the company, of course, Steve Ballmer and Satya Nadella. This is a great moment to talk about the last 50 years of Microsoft. That's why I flew out here. But while I'm here, I need to talk to you about this, which is Microsoft really, and it's a manifestation of the American dream and the manifestation of what turned out to be a global business that generated a global business, not just for Microsoft, but for so many other companies around the world. And so on a day like this, when everybody's trying to understand what they're supposed to think about these tariffs, not just the impact on Microsoft or others, but I'm curious what all three of you think of this and what you've been thinking over the last 48 hours. Satya?
Yeah, to me, Andrew, it just comes down to, as an American company, as a multinational company, I feel that, we have to earn the license to operate in every country, one country at a time, right? Every country is going to do what is right for themselves, starting with the United States. And so therefore, I always go back and say, is Microsoft adding local surplus, right? Are we making businesses in that country more productive? Are we making public sector more efficient? Are we helping with health outcomes, education outcomes? So as long as our contribution to the local society and the local economy is there, we have a license to operate. It's true in the United States, it's true in France, it's true in Indonesia. And so that's kind of what will ground us. You know, these things, whether it's trade and so on, will come and go, but we're very,
But
very
will it
focused.
come and go, and is it going to change your own plans? I mean, this is a company that's broken down barriers on itself around the world. And so, and now the United States is putting up a big barrier that's going to change, I imagine, the economics of your business, the economics of your client's business. You're going to be buying or not all sorts of computer equipment and other things to build out data centers.
There are two ways to look at it, right? One is the short term and the long term. In the short term, I look at it and say, whatever happens, whatever readjustment happens, we are, for the first time, really supplying what is the essential non-durable commodity called intelligence. The world has never had this, right? You know, when Bill started in 75, software was the thing, and today we have a more essential, and it's non-durable. Like, nobody's going to get up in the world anywhere and say, hey, I need less of it, I need more of it, and I need it daily. So we'll see how all that shakes out. The second thing is, 50 years from now or 25 years from now, what is the one thing you can be guaranteed of? Is the world needs more compute. So I want to keep those two thoughts and then take one step at a time. And then whatever are the geopolitical or economic shifts, we'll adjust to it.
Okay, let's talk about this. I'm curious from both of you and what you think of the tariffs themselves. You've talked to the president before, Bill. You know, what's your reaction to this? Other CEOs calling you, talking to you? What are you guys talking to each other about in this context?
You know, I'm not that expert on what the economic effects are going to be. So far, it's just on goods, but, you know, will it eventually be on services? Who knows? You know, Microsoft has benefited from being a center of innovation, and now, you know, building out in many countries around the world our engineering capacity. You know, so I'm sure that we'll adjust. You know, I'd say the biggest trend in the world today, even beyond the complex geopolitics, is the arrival of AI. You know, it's kind of weird to think a company's 50 years old and the most profound decade will probably be the next one. I'm surprised the politicians aren't talking more about AI. I think that's the next wave, is each country trying to shape, lead into this new AI era.
Steve, do you have a view? You never hold back. So what do you actually think is going on here?
I'll say two things. Number one, I took just enough economics in college to have said tariffs are actually going to bring some turmoil.
Right.
Now, whether that's desirable, undesirable by any government around the world and its citizens, you know, the democratic process or whatever process is in place.
But do you think it's desirable?
I think that disruption is very hard on people. And so a decision to do something for which disruption was inevitable, that needs a lot of popular support. And nobody could game theorize exactly who was going to do what in response. So I think citizens really like stability a lot. And I hope people, the individuals who will feel this, because people are feeling it, not just the stock market, people are going to feel it. You know, we'll see. Now, as a Microsoft shareholder, this kind of thing is not good, and it creates opportunity. To be a serious long-term player, we've invested, you started, in 78, working internationally. Microsoft has to be great for its customers. And if it does, no matter what happens in the short term with revenue, profit, share price, it gives an opportunity to reemerge and tell the citizens, not only in this country, but in France, in Japan, around the world, Microsoft is there for you. We're always going to serve you in the right way.
And real quick, before we get into the AI vote and go back 50 years, do you think that this changes that? The relationship that the United States, the halo that the United States has had, and on American business in all of these other countries that this company has done business with?
I mean, I would say, the tailwind of being an American company was huge, right? I always sort of describe it. I started in tech right after the Berlin Wall fell, and being an American tech company and riding that over the last 35 years has just been unbelievable tailwind. And this definitely changes that, right? So people want to know that you are more committed. That's why I go back to it and say, hey, we enjoyed the tailwind of being an American company. And guess what? Now we have to make sure that we double down on that local surplus, right? When you're in France, you have to be a French company. When you're in Indonesia, you have to be an Indonesian company. Yes, we're a multinational and an American company, but the license to operate is about the value add you bring to them. And that's what we have to really get back to. And the good news there, Andrew, for me is Microsoft's core business model is aligned with it, right? So I don't have to invent anything new. We don't have to change anything. From day one, when we do, in fact, one of the fun first thing I check in any country, in fact, I learned it from these guys, is you go and check how many partners we have, how much employment they have, how much revenue they make as a ratio to ours. That's the kind of classic metric brief that we all have been used to, and that's kind of what will really differentiate us.
Bill, I want to show you something, and I don't know if the camera can pick it up. This is the Altair. This is to go back a full 50 years. This is you and Paul on this machine creating this company effectively back in Albuquerque. Do you remember that?
Oh, sure. Paul and I had been lucky enough, Paul Allen, my co-founder, had been lucky enough to be exposed to software and to realize that with the miracle of the chip improvement, the key thing would be software. And so when this is first announced, Paul's moved back to Boston to kind of bug me to drop out of Harvard. And as soon as we see that being released, we decide, okay, we want to be at the forefront. And so I left school, and Microsoft actually spent its first 4 years down in Albuquerque, New Mexico, where the company that made that computer was. And then as we got more customers, I got to make the decision, do we want to go to Silicon Valley or come here to Seattle? And I ended up picking Seattle, which I think ended up being a great decision.
So that was a eureka moment for you. And now you say 50 years hence that you think the next eureka moment is AI. And I'm curious if you could all three of you, go to that moment, because you've been talking about it a lot for a long time. But then I think there's a famous story where Sam Altman shows up at your house and shows you something. What happens?
Yeah, so the idea that AI would be the future, I mean, it even predates me. Alan Turing talked about computers eventually being so good you couldn't tell the difference between a human and the computer. When I was in high school, there was Shaky the Robot at Stanford Research. And so the whole time of this industry, we've been saying, let's make these things smart. Let's have them recognize speech and images. And that really accelerated a little over 10 years ago. Still, the idea that the computer could read and pass tests was a little over 3 years ago when the partner OpenAI had ChatGPT-4, and I got to see the pre-release version of it. That blew my mind. That said to me that all this talk about intelligence finally was coming true. This thing could pass an AP biology test, which was the challenge I'd put to them. And so that's ushered in a very intense period where, even intelligence will eventually become almost free.
What's the relationship with OpenAI going to be long term? Last time I saw you in Davos, there was a lot of people asking questions about it. You guys just made a new investment in OpenAI. And yet there's also questions about whether Microsoft ultimately is going to have to build or wants to build its own large language models.
Yeah, first of all, we are very thrilled about all the success OpenAI has had. I mean, if you think about it, right, we are the early backers of OpenAI. They run on Azure exclusively. Every day somebody uses ChatGPT. They're using even Cosmos DB, and they're using Azure. So I'm thrilled for the success of OpenAI. We are also investors. We have a very strong commercial relationship. And one of the things, to Bill's point, it was super helpful to be partnered with someone who believed in scale of compute, especially as it comes to natural language. And so we saw it early together. We built the supercomputer. They built the model. We built, in fact, GitHub Copilot on top of it. And so it is a fantastic partnership. It's done well. And I think I'm pretty confident we'll continue to partner. Does that mean we will have to build our own capability as well? Absolutely. In fact, even while we were partnering with OpenAI, we had a model internally called Turing. We made an explicit decision to give more compute to OpenAI, and we're now building MAI models under Mustafa. These are all, and they're all going to be complementary. So when you use Copilot today, you're using many models underneath it, and OpenAI models are predominant there, but we also have capability. And so I feel very good about a long-term, at the end of the day, what I've learned from Bill and Steve is long-term stable partnerships matter. And in order to really keep them long-term stable, it has to be win-win, and that's our construct.
One of the big questions, and maybe it relates to tariffs as well, is people are building, including yourselves, a huge number of data centers. I mean, there is a massive investment that's going to take place over the next 50 years. What does that look like, and does it slow down at all? Because there have been reports that you're thinking of slowing some of that down even now. The deep seek of it all raised questions about just how much compute power there is. And there's just big questions about what the investment looks like and whether there's going to be, when we look back at this time, are we going to say that there was overinvestment?
Yeah, I see the point is, at the end of the day, look, there's one governor to all of this. It's called GDP growth, right? If the world grows, it is going to grow because there's a new input called compute/intelligence. Right. And so we'll have to be really matched up to it. Will we be perfectly matched every second? No. So is this something where we are committed to building out data centers across our 60 regions? We're absolutely going to. Will we make adjustments as we get new signal or even new efficiencies? This thing, your DeepSeek moment is a real thing, which is, hey, not only is Moore's law working, in other words, it's on hyperdrive, but the software efficiencies that on top of it, that means the fleet will be aged for a longer time. So we'll just make sure we ride that well in a capital efficient way.
You're the largest investor in this company. So.
Yes, I am. And if anything, certainly me as an investor, I love it when these guys invest. They're not leaving a hole, someplace that needs to be plugged. There is a bright and long future for storage, compute, intelligence. And the worst mistake for me as a long-term shareholder, if you want to own the stock 6 months, a year, 2 years, I don't know. I hope I'm not going to probably have 50 more years on the planet, but whatever minutes I have, I'm going to be a large Microsoft shareholder. And the only feedback I ever give this guy really is don't underinvest because it's just money. Serving your customer. No, come on. Innovating and serving your customers. You will be able to solve that problem even if you have a short-term hiccup where you build 6 extra data centers. I won't care as an investor. I won't, because I think it's more important to do that than to get caught short and not serve your customers.
Do you think there's a chance, though, given the Moore's law of it all, that there is an overinvestment in this world?
These models are still very energy intensive. And as Satya said, as the price of intelligence goes down, the demand elasticity for intelligence is pretty unbelievable, whether that's medical or new science, new drugs. In my work at the Gates Foundation, we're using these AI models to accelerate progress on pretty profound problems. And so I'll bet you'll go through some periods where you'll have a little bit too much. But in the next 10 years, I think we'll mostly be in shortage of electricity, shortage of data center capacity, and therefore the incentive to have a big capital budget, but also to be making those breakthroughs of the extra efficiency, the payoff is going to be profound.
Okay, how many players do you think will ultimately be in this game? Meaning there's you, there's Google. By the way, increasingly now you could look at Elon Musk and what he's doing. I don't know what you think of what he's doing right now. Meaning, how many players across the board? You have Anthropic, which is attached to some degree to Amazon. Are there only 4 or 5 players?
I think, first of all, you have to sort of think about, like always, the tech stack is complex, and there are many players depending on what layer you're talking about, right? So, and I think about AI infrastructure. First thing you've got to recognize is AI infrastructure is not just about the AI accelerator or the GPU. It's about that plus every other meter, right? Storage, network, core compute. And that's where the 3 hyperscalers or 4 hyperscalers, depending on how you count, are going.
How do you count, by the way?
I mean, look, we are one of the hyperscalers, and I'll let you define the market. But to me, it's actually amazing that the world, ex-China, has 3 or 4 hyperscalers. So that's why we're investing all over the world.
I feel like Steve
The
wants
answer's
to...
3.
Who are
No,
they?
the answer's 3.
Who are they?
No, that's the thing you have to figure out. No, seriously, the industry structure hasn't changed much in the software business. There's always a very small number of very large guys. Then there's a middle, and I'll say 3. Then you take a middle, and the middle might have a 20, and then you have a bunch of small guys. Now, Microsoft is one of the 3. I hope you feel pressure on your shoulders, but Microsoft will be one of the 3, and that's 3, 1 slot, done. You tell me who got the other 2. Doesn't matter to me.
Okay, outside of AI, is there some other thing that you think that Microsoft will be in? You got into games, right? Like that. There were these shifts, these big shifts. You bought LinkedIn. By the way, I don't know if you saw the news today about TikTok. Walmart, who you were about to do a deal with before, now Walmart's back in, or it says they're back in, and your neighbors at Amazon are also interested. Do you want to own TikTok?
I'm just going to watch the fun this time.
You're going to watch it. But where do you think this all goes then? Do you see what I mean?
Yeah.
Is there some other major development?
I mean, to me, this is one of those things where
maybe 25 years from now?
Here's an interesting thing, and in fact, we were all talking about it. At a time like this, when you have found the thing, I don't want to go looking around for other things. The thing that is going to power everything is intelligence and the compute required for intelligence. I want to make sure we do a damn good job of building out that infrastructure, the capital and the knowledge required, and then building the apps that we want to build, whether it's Copilot, M365 Copilot, GitHub Copilot, DAX Copilot for doctors. That's what I want to do a superb job. And by the way, enable a robotics company, enable an autonomous driving company, all to build on our infrastructure.
We're up against a hard break, so I'm going to go to Bill for the last 30 seconds. If you could start this all over again and you had to do it today, what would you be building?
If you're saying trying to start another big software company.
You and Paul call each other today.
Well, AI is the frontier. Paul and I had the advantage that very few people saw what we saw. You know, we would say to people, why don't you realize this is going to be gigantic? And, you know, today, everyone knows that AI is the next thing. You know, the number of robotics companies is huge. You know, the pace of improvement is huge. So it'd be interesting for, you know, a small company. You know, NVIDIA's the latest that rose from, they were up into that top tier
But based on Bill's mails to me, he would be building GitHub Copilot, he would be building M365 Copilot, and he would be building Copilot.
Yeah, and all, you know, software that can do software. You know, I've always believed in efficiently writing software, and so that's the ultimate goal of a software factory is to do it.
Gentlemen, I want to thank you. I want to wish you a very happy 50th birthday. Bill Gates, Satya Nadella, Steve Ballmer. Now over to Scott Wapner with today's closing bell.
Okay, Andrew, thank you very much. Welcome to the closing bell. I'm Scott Wapner, live from Post 9, right here at the New York Stock Exchange in the center of all of this. This make-or-break hour begins with Trump's tariff sell-off. Stocks plunging again as his trade war escalates. China retaliating now and nobody knowing where all of this is really heading. Let's show you the scorecard with 60 to go in this tumultuous week for your money. A brutal picture, as you know by now. We're looking at basically 5% declines across the board. Dow pretty much sitting there, not too much off the lows of the day. It's the worst week for the S&P since the COVID days of 2020. The NASDAQ just hammered today. Lots of big losses in some very big and widely held names as well. You could go down the list. Apple's, NVIDIA's, Microsoft and Amazon, Alphabet, etc. NVIDIA hit hard. Apple below $100, by the way. Now below $3 trillion in market cap. And how about the travel and leisure names getting crushed yet again? Almost everywhere you look today, it has been a very tough session. Tough screens to look at. It takes us to our talk of the tape. How bad is it really going to get? Isn't that what everybody wants to know? Let's ask our panel for some answers. Avery Sheffield of Vantage Rock, Cameron Dawson, New Edge Wealth, Malcolm Etheridge of Capital Area Planning Group. Malcolm's a CNBC contributor. It's great to have everybody here. What's going through your mind? What do you think?
Yes, very dynamic time, right? It seems like the markets are hinging right now on Trump and what he decides to do with the tariffs and every country's response. And so, given that uncertainty, we're still trying to look at where's there asymmetry to the upside and the downside. It does look like from the actions today that maybe things will be tougher with China because China's coming back with retaliatory tariffs. Maybe they'll be easier with Vietnam because Vietnam says, look, we want to really play ball. And so I think that things could play out differently by country, and given our exposure to imports in different businesses to those different countries, we could have very different outcomes for those businesses.
Are you looking to buy on days like we've just had, or are you afraid to buy because you're not sure where all this is going, as I said in the intro?
Right. So we actually are starting to see some opportunities both to buy, but also, we run long and short, but also to continue to be short. And the areas that, we think are most interested are stocks actually in consumer discretionary that have been so beaten up. They're like potentially pricing in tariffs. So stocks that are down to kind of pre-COVID lows from like pre-COVID, and more, but still more value oriented, because we do think there'll be a trade down effect that we haven't seen over the past few years.
You think a lot of the tariff news, to your point, is already in those names?
I think a lot of the tariff news is already in those needs, and especially when you start to see countries like Vietnam saying we'll play ball because it's so important to them. I think that suggests that we won't have the worst case scenario. But even if we did have the worst case scenario, I do think that the bigger will get bigger. Like the retailers that have the analytics, that have the tools, that have the value proposition, that have diversified offerings from grocery, more staples, to also discretionary, will probably be able to take share, because this is going to be very difficult to navigate through for everyone.
Malcolm, I really do feel like people are thinking that when you're down, 2,100 points on the Dow now, plus what we did to the downside yesterday, are things beaten up enough that if I'm a longer-term investor, I should? It's easier said than done because the pain feels so bad and you're not really sure where it's going to end.
So when you say longer-term investor, everybody's got their own different version of what that means, right? But I think that specifically for younger investors who are watching this and listening to us right now, this is the market that you've been waiting for. Since October 1st, I think, of 2022, the market's done nothing but go up and to the right, and you probably felt like you missed out on your opportunity to really build wealth the way your parents and grandparents have in this amazing growth engine that is the U.S. stock market. This is the opportunity. It's an unforced error that was handed to us by the U.S. president. And for anybody who's felt like they were locked out of this thing, you look back to 2008 and how many fortunes were created on the back of that great financial crisis. I myself graduated into that, so I had $10 to my name and missed that opportunity. This is similar to that for those folks who are looking at this. Very good quality names that have fallen off of highs by numbers we can't even calculate right now because the numbers keep bouncing on the screen. This is your opportunity to ignore the noise and the red on the screen, to your point, and get to buying.
What are we waiting for, Cam? Are we waiting for the president himself to capitulate on this, to the so-called Trump put, to not be able to tolerate this kind of carnage in the stock market any longer? What is the moment?
We are hearing this constant refrain of a hope that you're going to see Trump back off. And maybe that's one of the reasons why we still continue to see this weakness in markets, because there is still that hope that maybe you won't see the follow through. I think it's also really interesting. We heard from Powell today. The Powell put is off the table. The Fed is not seeing this as a reason for them to step in and ease policy. So it really puts the put in Trump's court. And the question is, does he see this as a fundamental restructuring of the U.S. economy, which means that the tariffs are going to stay, or does he see this as just a negotiating tool to get some wins? It's a big, huge question mark, but probably the ultimate question.
Yeah. Well, what do we think about the idea of a Trump put? I mean, we came into this year and after the election thinking, well, this is a man who cares deeply about the performance of the stock market, and his rhetoric over the last couple of days would suggest that not yet. Right now, maybe he doesn't. He's at his golf club. He's doing other events. He said things are going great, and he says things are going to work out. There's no sense from at least the president yet that he's had enough of watching his screen.
Right. Well, I think he said earlier this year that he's really focused on the bond market. And I think he's over the moon about the 10-year below 4%. Right. So he really wants to get interest rates down because interest rates coming down is going to meaningfully lower the cost of our deficit. And also it's going to spur demand. I mean, today you saw the home builders were actually up. Well, they're up actually for a legitimate reason. If you get interest rates down enough, you even had auto dealers up today, right? You're going to have these terrible auto tariffs. But if you're a dealer that can sell all different brands, sell more American-made cars rather than non-American-made cars, and interest rates go down, that's positive. So I think he feels like interest rates coming down and oil coming down are the two most important factors to drive more sustainable economic growth over the long term. And it does seem like he really doesn't care about the stock market in the short term. And to your point, I think he really wants to give those investors who've missed out on the stock market, the 50% of people who don't have money in the stock market, or younger people who've missed out on this opportunity, the opportunity to get in at much lower prices. I think he's fine with everyone who's made a killing to have to suffer and have a redistribution of wealth.
Well, he's getting a lower 10-year, as the Treasury Secretary has said repeatedly that they are fixated on, Malcolm, keeping interest rates low. The question is, do you come to a point of no return where you've hurt the economy bad enough through the wealth effect and the uncertainty and the lack of business investment and hiring, even though jobs report today showed a labor market that is reasonably resilient, though jobs are a lagging indicator, so it's really hard to glean too much from that. JP Morgan raises the odds of a global recession to 60%. There will be blood was part of their notation. Mohamed El-Arian, uncomfortably high risk of recession. Jeremy Siegel, biggest policy mistake in 95 years. Ed Yardeni getting harder to be optimistic. Editorials in, friendlier op-ed pages like the Journal, critical yet again of this sort of policy. What do you think?
If the president doesn't find religion over the weekend, and I mean literally in the next 2 days and come out Monday with some sort of reversal that we're talking about, it will be long-term effects and lingering effects. I don't know how we avoid recession, and I'm more concerned, forget the R word for a second, I'm more concerned about the S word, stagflation, where we have these inflationary tariffs, right? We're talking about a tariff rate going from about 2% in 2024 to about 22% according to estimates in 2025. That's the biggest tax imposed on American citizens in anyone's lifetime alive watching this right now, right? That can't be overstated. I think that it's very important that we consider what that means for us longer term, right? The put probably isn't coming, right? We know that this president doesn't like to reverse course on a whim like that because people are saying negative things. To your point, he's still golfing, right? So we have to consider the fact that this is probably long-term and lasting, which means that the playbook you came into 2025 thinking you were going to get to use, we have to rip that up and start over from scratch. Everyone who's sat at this desk for the last 5 years has talked about a stock picker's market. We're going into a stock picker's market, myself included. I think we're finally walking into that. To the point about the 10-year impacting mortgage rates, if I were somebody who was interested in buying the mortgage servicers, here's your opportunity to go pick some really good names. As an example, if I was somebody who was looking at tech, I don't know how you get a return in the stock market going forward without tech being included in that. I'd be looking at a lot of the tech names, but I'm not going to buy the entire market in aggregate with the Qs or something else. I want to pick the individual names that I've been watching and that I think are really great companies that shouldn't be selling off at basement prices right now.
So this statistic, Cameron, that I'm going to read you is just from Thursday. Mm-hmm. And given the declines today, you can probably double it. But the Mag 7 collectively lost $1 trillion in market cap on Thursday. Judging by the activity in a lot of those names, you're probably close to a repeat of that. You've had year-to-date declines that are so significant off the highs of 50% for the Teslas of the world and 38, so forth down the list. It's just ugly. Have they come down enough?
So on Monday, we published a bear market price target of 4,700 on the S&P 500. And we thought on Monday that that was a really scary number. We never thought that we would get that far, that fast. We're in 5% spitting distance of it. And part of it was recognizing that you still had a very high multiple and a lot of air to come out of multiples, given where we were starting on Monday. And a lot of that air is coming out of the Mag 7 and coming out of names like the big tech names. But you're still trading at 21 times forward in the big tech index. You bottomed around 19 times in 2022. So to your point, you're likely getting close. We do think tactically, given the degree of oversold statistics that we're likely to see in percentage of names at 20-day highs, put-call ratios, flows into short ETFs, that you're likely near a tactical low or a tradable low in markets just because we've moved so far so fast. Does that mean that this is a V-shaped recovery? We don't think so. We think that you have dented this trend enough that you certainly could see more of an unwind post that bounce. But at least in the very short term, the degree of oversold suggests that you could see some kind of tradable bounce.
You know, the big question, I guess, is going to come down to what earnings end up being through all of this. I'm not sure you're going to get a great read starting next week. You will more so in the commentary than the numbers. If you look ahead to next year, as Wall Street obviously always does, and you've had Goldman come down from $280 on the S&P earnings to $269. And who knows if that's going to be legit or they're going to have to reduce again. 17 times that is $45.90. We're at $5,100. I'll give you 18 times. Give you 18 times. That's $48.42. My point being, it's still significantly lower than where we are now, and we suddenly have so much uncertainty introduced in the whole equation of what earnings are going to be and what you should be paying for stocks.
Agreed. And I think there are still a lot of stocks that have very meaningful downside. I mean, almost the entire software sector, not all of the software sector. I mean, those companies' valuations are dramatically higher than the market. And
you still think they're too high?
Absolutely. And I mean, we're seeing, just it checks even out through the past few days that there's a significantly more increased business scrutiny on large software deals. And software is considered to be acyclical. It's actually acting very cyclically in the checks that we're hearing. Of course, we'll hear, in the earnings announcements and forecasts, you have a lot of other growth names that are trading, honestly, still on ether valuations that are economically cyclical. They've been seen to be secular growth stories because they have great, they offer services that people really like, that they're willing to pay for when they have a lot of money. But when they have less money, maybe people go to Kroger rather than asking for delivery, for example. So I think that there's a lot of movement still to come. Also in the luxury space, luxury names are still much more expensive in general, and some are very expensive on an absolute basis. And this wealth effect, you would think, would have some impact. So that's why we prefer, a barbell approach. Like we're focused on owning names that are already pricing in a lot of uncertainty. You're talking about multiples, even on earnings that are down maybe 50%, 10 times earnings. Like we're looking at buying stocks like that while shorting stocks that are very expensive and actually have underappreciated cyclical characteristics.
I want to take the other side of that trade. Sell me your shares, right? I'm looking at a company. Cameron, you just mentioned we're down to 20 times next year's earnings now on average in the Mag 7. 90 days ago, we were sitting here debating whether 30 to 40 times next year's earnings was too much to pay for these companies. We just saw Microsoft celebrating their 50th anniversary. Am I worried that Microsoft is going to go out of business in the next 5 to 10 years? No. So is this a great place to be adding shares of a company like that, a powerhouse in the tech space, to my portfolio? Absolutely. I think that realistically, the conversation feels like it has to be short-sighted, and we have to really think about valuation today. But I'm really thinking about locking in longer-term appreciation over the next 5 years, 10 years, and we are being given a gift in this market right now.
I would go as far as to say, I think when we're talking about some of the software names, that Avery's not necessarily talking about a Microsoft per se, but some of the other software names that have much higher relative valuations than a Microsoft does, ones that have gotten a nice AI lift. I don't want to pull any names out of a hat.
Absolutely, yes.
But, there are cybersecurity related stocks that have gone up a lot. Am I correct?
Yes.
We also just heard from Microsoft, they were asked, are you overbuilding or do you need to pull back on capital spending? And Satya Nadella just said a few minutes ago, well, it does depend on GDP.
I honestly, that comment stuck with me as well. It honestly stuck with me right when he said that. I'm like, okay. So one of the bull cases was, all of this CapEx that these mega cap companies are going to continue to